Hello everybody, my name is Nicole and I'm a technical analyst and private investor. And what I've noticed over the last 10 days or so is the commentariat muttering about whether the US Federal Reserve is going to set their target rate at a negative number, less than zero, which is the case in several countries here in the ECB and Switzerland and a few others. And it's highly unusual monetary policy, but then, well, unusual days, what are we going to do? So I don't care what the central banks are doing. I really don't care, because I prefer to watch the top quality bond markets and the junk bond markets, because they march to a completely different beat, and they usually beat and are streets ahead of a central banker. And so today, the US 2-year bond yields a pathetic 15 basis points, with a record low at 10 basis points, i.e. 0.10 a couple of weeks ago. So do you know what I mean? That's nothing. That's next to nothing. And whether we go negative or not, the whole thing is irrelevant as far as I'm concerned. So is this possible? What's going to happen? Well, let's look at somebody who's streets ahead, and I'm going to look at the German sovereign bond market. This is my first chart. It's a monthly chart going back quite a while of the yield on a 2-year German Schatz, 2-year German government paper. And as you can see, this has been negative since 2014. And the mean regression at the moment lies at minus 70 basis points, so minus 0.7%. And, we've had a new record low in March. And I mean, quite frankly, this thing is working at a glacial pace. It's not really going anywhere. It's got nowhere much. Well, it could go anywhere, but it's not. It's steady as she goes. It's certainly not normal what they're doing here, but that's the reality. And it has been for many, many years. Now, moving on to my second chart, if you think that, the Schatz is extraordinary, well, look at this one. It's again a monthly chart over exactly the same period of time, but this is a 10-year Swiss franc government bond. And as you can see, again, it's been negative for many years. But that's maybe not so surprising, because the Swiss National Bank has been the most aggressive in terms of its low interest rate scenario, quantitative easing, buying up this, that, and the other, putting it all in their coffers. But here, the thinking is different. This is because they don't want the Swiss franc to get any stronger. It's been too strong for too long. So this is why they're doing all of this. Now, what you're going to say is, well, look, if you're printing money like Billy-O, then of course we're going to have massive amounts of inflation. I'm sure you'll have heard this already. You're going to hear a lot more of it now, as the Bank of England decides how they're going to bail us out of this coronavirus catastrophe. But actually, over this exact same period of time, Swiss consumer price inflation has dropped from plus 1.1% per annum to minus 1.1. So we've got negative inflation now in Switzerland, as well as negative bond rates. My final chart, and this is a real eye-waterer, is British 10-year index-linked yield, index-linked. So it has a regular coupon, plus you get retail price inflation tacked onto it, which is a variable, okay? It's not fixed. You don't know what it's going to be. The current yield is minus 270 basis points. That's minus 2.7%. It did get to a record low at minus 310 basis points last year. So this has got nothing to do with the virus, yeah? What it is, investors are lapping this stuff up because of the optionality of it all. I would suggest that perhaps the Bank of England should consider something like this.